Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is July 8th, and we have returning guest Charles Hugh Smith. Charles is author, leading global finance blogger, and America's philosopher, we call him. He's the author of several books on our economy and society, including, and most recently, The Mythology of Progress and Self-Reliance in the 20th Century, and also just actually hot off the press, Ultra-Processed Life. And we'll do another podcast on that in the near future. And Charles's blog of twominds.com is one of CNBC's top alternative finance sites. He also now has a great Substack at Charles Hugh Smith, all one word, .substack.com. Welcome, Charles.
Thank you, Richard. I'm looking forward to today's topic. We're going to try to connect a lot of dots that are complicated and easy to misconstrue.
Yeah, absolutely. And so we'll discuss some of the connections that are between things like interest rates, bond yields, currency valuations, inflation, national trade, fiscal deficits, surpluses, basically the overall robustness of the global economy. And we'll discuss it from different directions. So maybe you wanted to set the context for this, Charles?
Yeah. Okay, Richard. Well, we, as you and I have been discussing this topic over the last few weeks and emails and so on. And so we both kind of feel that the way to start is to look at the way that governments in throughout history have dealt with soaring debts, right? Soaring sovereign debt. And of course, the time-honored way is to inflate it away. Because the other options are worse, which is defaulting and then creating like a financial crisis, or higher taxes, which tend to suppress, consumption and productivity. So inflation is going to be the way we're going to go. And then the other context is, since the 2008 global financial crisis, all central banks have used the same sort of gimmick to be able to borrow, but keep their cost of borrowing down, which is to suppress bond yields, right? And they've done this with, QE and buying their own bonds and so on. So that seems to be running out, though. That game doesn't seem to be working anymore because bond yields are rising globally. So maybe you can you've had a lot of recent guests, and so maybe you can fill in some of the blanks I left in that quick summary.
No, that's great for the context. Thanks, Charles. And yes, I think we actually go way back, like post World War II. Since then, I guess one of the flaws of representative democracy versus direct democracy is that you have politicians that will say, elect me and I'll give you all these things for free, and we'll just print money and borrow money and all this. So this has been going on since post World War II. And the debt has gotten higher and higher. Of course, as you mentioned, in the great financial crisis, there was a lowering of interest rates for quite a number of years after that, which essentially and effectively lowered the servicing costs, right, on that debt, so that it could actually grow more. It could grow higher, more in debt, but at lower interest rates, giving overall either the same or lower servicing costs for that debt. So that financial repression tool has been going on, but we've sort of reached the end of that game, especially with the canary in the coal mine of the repurchase agreement market that began percolating in 2019, 2020, and those times where a natural reaction of unsustainable too high of a debt would be those interest rates in the repurchase agreement market going higher, and that's what they did. So what is the tool now since then that's been employed? Well, as you mentioned, it's inflation, and that's usually the financial repression tool of choice by governments throughout history. Of course, you have the other options, raise tax or default, outright default on the debt. So those two options are generally not acceptable. Notwithstanding, Dr. Mark Faber yesterday on another podcast actually mentioned he thinks there's a possibility for the U.S. to actually default on the U.S. debt. So that's actually becoming an option. But generally it's inflation. So, you get inflation going for 10 years at 4%, you can reduce the burden of government debt by 1/2 if you do the math. And then we have higher inflation, so maybe it only takes 6 or 7 years to reduce the burden of the debt. Your thoughts on that, Charles?
Yeah. Richard, let's look at Japan, because I think Japan is a good example of sort of the G7. It's just more advanced, if you will, because the population, many of the issues in Japan are now apparent throughout the G7, right? The developed nations. Like demographically, Japan's population has been aging for the last 30 years, and now we see this as a global trend. Japan's economy has sort of stagnated, another trend we can see elsewhere. And then Japan has been successful for 30 years in suppressing bond yields, right? It was like the Bank of Japan was making huge purchases and pushing yields to like a tenth, keeping them at a tenth of 1% or something. But I think that what I want to speak to and use Japan as an example is now the things are breaking down in Japan. The price of rice is soaring, right? It's gone up, I don't know, 60% or something. And now that's impacting a society that was used to either mild deflation or no inflation, right? And so now this is triggering a potential political crisis because now inflation is rearing its ugly head. And it's also disrupting the bond market because Japan's the yield on its bonds is soaring because the Bank of Japan was trying to withdraw this kind of financial repression and try to sort of what we call normalize the bond market. So this is typical of many other countries, that I sent you, and you can post in our program two charts of Japan's budget and revenues, and we see what happens. And so, in other words, my point here is it's easy to kind of focus on the financial aspects of the bond market and interest rates and what central banks can do, but we have to realize demographics has a huge role here because Japan is having to borrow tons of money to support its aging population, and that's a trend that's global, right? And including China, its population is aging, South Korea, the U.S., Europe, and so on. So governments are now forced, because they've promised a lot of these benefits to the elderly and retirees, that they have to borrow huge sums of money. And here in the U.S., Medicaid and Medicare alone are like $2 trillion. And then, Social Security is another 1.2 trillion. So you've got half the federal budget is these entitlements, mostly to the elderly or to the poor. So you have to borrow more money. And then if inflation starts rising for reasons that the central bank can't control, for example, food inflation, energy inflation, inflation from trade wars, global climate change, et cetera, et cetera. There's a lot of reasons for inflation to rise that the central bank can't control. So that's how we see yields rising regardless, because investors and money managers are realizing risks are rising that they can't control. So therefore they demand a higher yield on bonds. So you get into this situation where we can kind of read the tea leaves, and we see that economies are stagnating, demographics are negative, and bond yields are rising. Well, that's the closest analog period we have to that is the 1970s, with a higher energy and higher inflation. And then the governments are crunched because now what happened in the 70s is you're limited in how much you can borrow, because the interest you're paying is now a significant part of your federal budget. And that's what's also visible in Japan's expenditures is the percentage that's going to pay the interest on their bonds, even though they're still at a very low rate, the quantity of bonds is so vast that a significant part of their federal expenditures is interest. And we're seeing the same thing in the US. So we're seeing these two tidal forces, kind of inflation and financial repression, changing course.
Mm-hmm. Yeah, those are great points. And yeah, I think if these yields keep rising, whether it's in the US or Japan, yeah, it poses significant adverse outcomes in a number of areas, a number of markets. Obviously, there's the housing market. Interest rates go higher, especially on the 10-year. That'll affect the mortgage rates, right, going higher, and then the price of a house going lower at the same time. And so, not to mention affordability, right? How do you afford the payments given high interest rates, on the part of the buyers of homes? But it also extends to like the derivatives market, with especially if interest rates change rapidly, but even in terms of absolute terms, changing higher and also rapidly at the same time, especially, that's even worse. But yeah, that could also trigger derivatives meltdowns of different markets in the derivatives world, interest rate swaps. So there's a lot of negative effects. So I think in the end, I think it's still the idea that, especially now, given that foreign central banks, foreign governments are not buying as much, or no longer buying U.S. Treasury bonds for whatever reason, could be geopolitical or otherwise, or they're repatriating some of that to build up their own industries. Even in Japan, you're seeing that as well. Then it comes down to monetization of the debt by the central bank, which essentially creates inflation and lower the purchasing power of the currency, the dollar in this case. So the dollar will likely, in my opinion, be sacrificed to keep interest rates low. So that way the system keeps going. Mortgage payments are still able to be made. Interest rates are moderately, reasonably held low, but it's at the sacrifice of the currency. What are your thoughts? Do you see that playing out in that direction, Charles?
Yeah, Richard, that's a great topic. That the connection of how does the global market value your currency, and so we've seen, like, the Japanese yen, for example, fell like 20%, in the last couple of years. It was a huge drop after being stable for quite a long time, and so that was the global markets take on the situation in Japan. I think is reflected in the fact that the yen fell, right? And so that when you allow your currency to be priced by the market, which inevitably there will be a market price, even if you try to, control your currency's valuation. So there's I think what the baseline for me is, as global risks rise, then people start looking at these things much more carefully, and they're trying to mitigate their risk by diversifying. And so when you and I have talked about de-dollarization, and so a lot of this is just simply risk management, right? And so that's why people maybe fled the yen. They were just managing risk, right? They didn't want to stay in the yen and maybe suffer a decline. So the other thing is, China had a huge deflationary impact from 2001 to like 2000, say 19 thereabouts, right? Where China entered the global market, and it reduced the cost of production and the cost of goods so significantly that the G7 and the developing world alike, they got a deflationary wave from China. And then China's financial sector was also expanded to a global scale. And so, I think that it's generally conceded that China's credit impulse was a major factor in pulling the globe out of the recession of 2008, 2009. So China kind of provided this huge deflationary impulse to the global economy at the same time that central banks were repressing interest rates, bond yields. They could get away with that partly because of China. But now China's reached, due to its incredibly fast development, it's already reached the point of a fully developed nation. So it has a lot of the same issues as a developed economy, right? That it can't use its sort of boost phase. It's already gone through its boost phase of using real estate and exports and so on to grow, and now it has a slower growth path, right? So now these the rest of the world has to deal. It doesn't have a deflationary impact, from China anymore. So now it's now finally having to deal with the underlying inflation. So I think that and demographics plays into inflation too, because the workforce shrinks, right? Like the average age of farmers in Japan, since we're talking about the price of rice, is something like over 65 years of age, right? I mean, you're talking about geriatric farmers and the age of and the and so if you're not going to have a workforce that can provide you with food, then you're going to have food inflation, right? So there's those kinds of elements. But I also want to speak real quickly to this idea that productivity is the underlying value proposition in any economy, right? That an economy that's increasing its productivity, meaning that it's getting more goods and services out of the same quantity of capital and labor, then that is what is the foundation of prosperity, right? That growth can then be distributed across the entire economy, and so we call that total factor productivity, which is a different measure because it includes the impact of technology, innovation, and sort of like the whole package. And so we look at the developed countries and we see stagnation. And again, as I said, Japan and China, South Korea, the Asian economies are now fully developed as well. And so they have the same sort of stagflationary problems as Europe and the US. So in this kind of idea, like, well, where is the productivity globally? And as you have been pointing out for many months, the productivity growth is in the global South, right? Because the workforce is younger and their economies are less developed, so there's more potential for productivity. And so I guess I'm kind of raising two issues. One is, how do the developed countries get out of this stagflationary spiral? And there's no easy answer. And then
no easy answer.
Right. And then we're going to see capital flow and possibly talent flow to the global South, because that's where the productivity gains are. In other words, it's not just financial, it's what are you doing with your capital? And as you and I were discussing before we started recording, in the US, we expend huge amounts of capital on, AI and kind of BS work, right? Compliance, consultants, and stuff that doesn't really increase productivity. And so that's partly why the US economy is stagnating.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and market environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
Yeah. If you look at jobs board, like in the global South relative to the G7 world, like what do you see in the global South that might be advertisements for openings as, scientist, engineer, for high-speed train development or something like that. So there's design, there's development type of projects and work, whereas in the G7, it's mostly, regulatory compliance officer, government employee oversight, tax preparers, accountants. It's basically there's not much going on in terms of design and development, lawyers, all that. So it's mostly stagnation, as you say, right? That the jobs are reflective of the economy, and this whole idea of reshoring is just a pipe dream, I think, and it's not being thought out carefully. In the old days, small changes in the financials could affect a big change in the economy, but we're past that. There needs to be a structural change that takes time. As you said, it's not easy. So you're going to need to educate your people, right? Educational, that takes a whole many years, a generation even. Not to mention the regulatory aspects. There's just too many regulations. I think this is what Elon Musk saw in the Doge, right, effort, that there's just too many regulations in place that are prohibiting or restricting economic growth, right? There's like duplicate regulations, overlapping, obsolete regulations that are restricting economic development, and then regulatory capture-based regulations, right, that are written by large companies that give donations to politicians help them get elected, and in turn the politicians sign the legislation developed by the lawyer of those large companies. And the legislation basically is written such that small entrants, like somebody out of university, has a good idea. There's no way for them to compete, right, with those large. Through that legislation, it'll be prohibitively expensive or outright impossible through regulations to be alive, right, to compete with that large company. So that has to be addressed. But it isn't, right? There's nothing going on there. Not to mention the rare earths, right, that are needed, where the U.S. is lacking severely behind China on that for many industries across all sectors, right? There needs to be that input, plus intermediate goods. And now that you've got effectively a 55% sales tax through tariffs on the Chinese, it's not phrased like that, but that's essentially what it is. That's going to create inflation. That's going to create intermediate goods to be much higher and make it difficult for all of the reshoring and the manufacturing. Your thoughts?
Yeah, and that's a very good summary, Richard. And I would just say that every economy is, of course, has two aspects, right? It's international because there's trade flows, and then it's domestic. And so the domestic economy tends to be dominated by subsidies, right? Like powerful constituents manage to get some kind of, as you say, a regulatory capture or some kind of tax break. And so those are basically skimming off some of the surplus of the economy that can't be then invested productively, right? So when that becomes a larger, that kind of domestic subsidized economy saps your economy of its core strength. If it's soaking up most of the surplus, then you're going to be like basically short of productive capital. And I think that's a good description of many economies. The U.S. I mean, I just received some comments on a post I did about the healthcare system, and a physician in the U.S. said that she got a check from a big U.S. insurance company for 2 cents, which she was going to frame on the wall
Yeah.
because that was all they were going to pay of this claim for some person. And so, and she said, and so this kind of sclerotic moral rot, like the whole healthcare system is nothing but this giant skim or scam, however you want to call it, that's burning out the caregivers. And it's horribly expensive, like the US healthcare system is like twice as expensive per capita per person as Japan, right? Just that's one statistic of many. So you go, how do we reform these heavily subsidized and heavily moated kind of cartels and monopolies? And it's like, it's almost impossible without some kind of financial crisis that forces a sort of redistribution of the nation's wealth, right, to more productive uses. And then I also want to mention, that there's a lot of talk here in the U.S. about economic nihilism in the youth, right? In other words, the young generations that were told to go to college and they're going to be guaranteed a great job. Then it turns out those that were told learn to code, well, their unemployment rate is like 20%. And then those who were told go get an MBA, their unemployment rate is 40%. And so it's like we're not making use of our intellectual capital either, you know? And so as you say, that where is the training needed to reindustrialize the US? And as you pointed out, it's totally lacking. I mean, like the trade schools and the community colleges have basically rotted away beneath us. And so to implement changes at all these multiple levels and means getting rid of the subsidies to all these moded constituencies as special interests, and they're going to fight tooth and nail to keep it going. And so it's sad to say, but I don't see how we can break their grip without some sort of crisis that forces a reappraisal of the whole structure, you know, political, economic, and social.
Yeah, it's giving like a bad name to education. It's giving a bad name to the system. Like on education, you know, it is true that if all work is very valuable and high value, and so people have come to a conclusion that maybe I should just go to trade school and be like the local tradesperson, landscaping, plumbing, and things like that. And nothing wrong with that. And it actually makes good money because the rates are local, right? You cannot outsource that to India, you know, for example. Whereas if you went into IT, you know, you said I went to college, and now I'm in IT, I can't get a job, or I am, but I'm competing with India resources that are much lower billing rates, right? So my overall billing rate is very low, you know. So that's you know, it gives an idea. If you went to college, you're not going to get paid as much, right? Whereas the real answer is look at what's happening to China, right? They value education very highly, and more engineers graduating every year than that exist as engineers in the U.S. on a yearly basis every year. And they're able to translate that capital, intellectual capital, into development, right? Into economic development, high-speed trains, all that. And you know, even here, right, in North America, you'll see what are the projects going on. It's mostly very low tech, you know, asphalt pouring, filling potholes. You know, there's no really high-speed trains. I think they've tried to get a high-speed train in California going for so many years, and between Montreal and Ottawa, also this is just impossible from the regulations as well. So, you know, all of these things need to change. But yeah, education is getting a bad name. The system as well, right? Because now you got even like ultra socialist, bordering on communism mayor, right, in New York City. I don't know if that's a trend, but it's the idea that people are looking to alternative ways of economic thought rather than reforming what we have now, right? All the regulatory capture, the crony capitalism, the cartels, as you've written extensively about. Could you elaborate on that? Yeah.
Yeah, Richard, I think we're looking at what are the solutions? Like, in other words, we're sort of just kind of in broad brush. We're saying governments are going to, you know, choose to inflate away their soaring sovereign debt. But that's going to be problematic because bond yields are rising due to rising global risk and rising inflation from sources that the central banks can't control. So you go, okay, this is kind of crunch time, right? More and more money is going to be going to paying interest and so on. And I think that the core answer, whether you call it capitalism or socialist, you know, ownership of the means of production, and never mind what ideological label you want to assign to it, it boils down to we have to become more productive. We can't be squandering our intellectual, you know, our human capital and our financial capital in kind of propping up a bunch of really corrupt, inefficient, and wasteful cartels and moded special interests. So that's the core is raising productivity. And so how do we reward that? And so that's because you've got to create an incentive for that. And right now the incentives, as we're saying, are kind of perverse. Like the incentives are build a moat around your cartel and then you can, suck off the federal government. and,
yeah.
and that's true in many nations. Like, in other words, Japan has a very strong, because of its political system, which we won't go into, then the farming community or the farming cartel has a lot of political power. And so it's very hard to reform the agricultural sector in Japan. And I think in China, we could see that how China's trying to transition away from its dependence on real estate, right? That became like a subsidized industry that was sucking in capital and deploying it in unproductively, right? And so, every economy has the same problem. How do you redistribute capital to be more productive? And there's going to be winners and losers. And if the losers have most of the political power, then you're going to be sort of stuck in stagnation. And that's unfortunately where we are now. So, but that's what I think I would end on. The positive note is there is opportunities for increasing productivity, efficiency, better training, getting more out of every hour of labor and every dollar of investment. And if we could focus on that, then I think we'd be able to make progress.
Yeah, absolutely. And I like that ending on a positive note. And a lot of these ideas stem from your many books. How could our listeners and viewers learn more about those books and where to find more information, like on your Substack and also blog writings and books?
Yeah, please visit me at of2minds.com. I have sample chapters of all my books there, and a lot of links are in my Substack, Charles Hugh Smith at substack.com. So thank you very much, Richard.
Well, great. Thank you, Charles, and look forward to doing another podcast on your very new book, Ultra Process Life.
Yes,
very interested on that. Yeah, thank you so much.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.